Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we will discuss the financial health of the American consumer and what it means for the economy and long-term investors. Consumer spending accounts for roughly 2/3 of U.S. economic activity, making it one of the most important drivers of growth, corporate profits, and ultimately markets. So understanding where consumers stand today is an important part of making sense of the broader economic picture. The picture right now is positive but mixed. Some indicators are quite strong, while others suggest many households are feeling the strain of inflation. Over the next few minutes, we'll walk through what the data shows and why it matters for your financial plan. First, let's talk about how consumers are feeling and how that compares to how they're actually behaving. According to the University of Michigan survey, consumer sentiment sits at 49.5, well below the historical average of around 84. That places sentiment near historic lows, comparable to the depths of the 2008 financial crisis and the early pandemic period. And yet, retail sales have grown nearly 7% over the past year, well above the long-term historical average. So there's a real gap between how consumers say they feel and how they are actually doing. A big part of the explanation is that even though the rate of inflation has improved, prices of everyday goods and services are still much higher than they were before the pandemic. Consumers feeling the weight of higher grocery, housing, and energy bills may express pessimism in surveys, even as they keep spending on both necessities and discretionary items. Next, while sentiment is low, the overall balance sheet of American households has never been stronger. Total U.S. household net worth reached $183 trillion in the first quarter of 2026, a record high. Growth in financial assets like stocks and retirement accounts, along with non-financial assets such as rising home values, has driven much of this increase. That said, this strength is not evenly distributed. For some, wage growth has been solid, but rising debt levels tell a different story. Credit card balances have reached $1.3 trillion. Auto loan balances $1.7 trillion, and student loan balances also $1.7 trillion. This is sometimes described as a K-shaped economy, where different segments of the population are moving in different directions at the same time. For markets, what matters most is the overall growth rate of corporate earnings, which has remained healthy. So while the picture is uneven across households, the aggregate data continues to support a positive economic outlook. Finally, the personal savings rate has declined to 3%, well below the historical average. Several factors help explain this. Strong consumer spending has naturally come at the expense of saving. Higher prices for necessities leave less room in each paycheck to set aside. And as the baby boomer generation moves further into retirement, they're drawing down accumulated wealth rather than adding to it, which pushes the aggregate savings rate lower. From a financial planning standpoint, a savings rate this low is an important area to focus on. The power of compounding means that dollars saved and invested early in a financial plan can grow substantially over decades. On the positive side, oil prices have declined from recent highs, which could ease some of the inflation pressure weighing on consumer sentiment. The job market has also shown improvement and unemployment remains low. These are encouraging signs for consumer outlook going forward. We hope you found this overview helpful. Whether it's building a savings plan, reviewing your portfolio, or thinking through long-term goals, these are exactly the kinds of topics we enjoy discussing with clients. Please don't hesitate to reach out. We look forward to speaking with you.